Good morning, everyone, and thank you for joining us on Morning Markets from True Potential. Today, we wanted to do something a little bit different, reflect back on what has been a very volatile start to the year for asset markets in both equities, bonds, currencies, but also to bring in Chris Leyland, our Director of Investment Strategy, who you'll be very familiar with from Morning Markets, but just to bring to life some of the market movements that we've seen through the course of January. And really, when we look back over January, it was certainly a month of volatility, one that started with the movements that we saw in the sovereign bond market, but then gradually moving out over the course of the month into the equity markets, and very significant divergence in equity markets over the course of the month. If we look at the US, we've talked about the strength in the US over the course really of the past 2 years and longer. But for the first time in many months, we saw that leadership change with US equity markets being weaker, particularly the growth areas of that market, consumer discretionary, information technology. And for the first time in a very long time, I'm able to say that the UK market was relatively unchanged over the course of the month, significantly outperforming regional peers as a result of that. But maybe turning to you, Chris, just initially, could you maybe give us your thoughts on what we saw in the sovereign bond market over the course of January?
Yeah, absolutely. Good morning, everyone, and thanks, Jeff. I think if we look at bond markets, in particular, I'd say sovereign markets, they've really been the epicenter of activity. And why is that? The reality is you've seen significant moves, and that's as investors reassess interest rate expectations. And I think really for me, there's one thing that I think is really important to get out there straight away, and that is that it's not normal for interest rates to remain at near zero levels. If you think around why interest rates were cut just under 2 years ago, it's because of COVID, and we were going through a really difficult period. Therefore, there needed to be some kind of stimulation in the background to help economies overall. But where are we now? Well, actually, we're in a much more positive space. The reality is that you've got good economic growth forecast for this year into next year. You've got strong consumer demand. You've got generally a healthy consumer. You've got healthy corporates. They've got generally healthy balance sheets. Therefore, it doesn't make sense to have interest rates at such low levels. But really just building on sort of Jeff's point, how's that affected bond markets overall? So bonds have different maturity profiles. So longer dated bonds whereby you are lending to a government, in the case of sovereigns, for a longer period of time, are more sensitive to interest rates, more sensitive to growth and inflation expectations, where shorter dated bonds are more reflective of the current policy environment. But let's look at how they've moved. So if we look over the month of January, and maybe we start with the US, so the 2-year note has declined in price. So the yields have moved up from 0.73% to 1.16%. And the 10 years moved up from 1.51% up to 1.79%. If we move across the Atlantic and we look at UK gilts, you can actually see there's been similar moves. And maybe this is a bit of a theme within bond markets in that, obviously, Jeff talked about the divergence within equity markets and how the UK had been pretty flat, but the US had done not so well. But the reality is in bond markets, you've generally seen similar moves globally overall. So the
Chris,
UK,
I suppose a lot of that is coming back to changing expectations for monetary policy, and that's been driven by the inflation backdrop that we've experienced over the past 12 months effectively. Is it right to think about that as the main driver of the move that we're seeing in sovereign bonds?
Yeah, absolutely. If we look around the world, you've obviously got inflation at elevated levels. If we look right now, obviously there's various different inflation prints that have actually come out today and yesterday. But maybe if we take Germany as the example, we saw German inflation coming in at 5.1%, and that's a fall from 5.7% the previous month. But really, what's the key there? The key there is that it's elevated. And actually, it was enough to take the German 10-year bond into positive yielding territory. So that's the first time since May 2019. So for me,
And
yeah, definitely, I think
that's the
one of
other
the big moves.
factor that we've had to think about over the course of the month has been volatility in different asset markets, be that equities, be that bonds, as you've discussed there, but also this changing interest rate or interest rate expectations have certainly been very favourable for currencies as well, or for certain currencies, and maybe some currencies in a surprising manner as well. So we've seen the dollar about 1% stronger on a trade weighted basis over the course of the month. We've seen some emerging market currencies perform pretty well as a result, which is, I suppose, somewhat surprising, just given that interest rate backdrop that we've seen for the US. I think the other thing there that we have to really think about is that commodity producers have been very strong, and if we look for areas of the market that have provided positive returns over the course of the month, certainly energy has been one of those areas that has been positive.
Yeah, absolutely. I mean, I suppose the big headlines, if you look over the month of January, if you look at Brent, so Brent crude is traded through $90 a barrel. So it's 15% up over the month, and that's back to the highest levels since 2014. I guess why is that? You've got the geopolitical tension between Russia and the Ukraine, and you've still got elevated gas prices there coming through. So again, some quite big moves in asset prices overall.
Okay, thanks, Chris. And then just bringing it back to today and overnight, what have we seen? Well, clearly we had the RBA following, as expected, I suppose, what other central banks have been doing, signalling an end to their accommodation of low interest rates and their quantitative easing program. So thinking about the exit mode, as you've said there, as we move further through the pandemic. So something there to certainly focus on as we go through today. And then we've had house price data from the UK as well, which continues to show the strength in the UK economy, or that segment of the UK economy as well.
Yeah, I think for me, I'm actually at the moment trying to buy a house. So house price data is quite pertinent for me, and I think when I look at those figures, probably a couple of things come to mind. I think firstly, affordability, and second, as cost of living becomes higher, can house prices continue on that trajectory? I think that's fairly unlikely right now. But I guess for me, just outside of that, just thinking around, what else is happening this week. Probably the big thing is the Bank of England meeting, and that's coming through on Thursday. And obviously, we'll see what their decision is. But I think as well as that, also the rhetoric that comes through from the minutes that they have, from the information that they bring overall. So for me, that's really the key data point this week.
Okay, so for our viewers, let's stay focused in on the Bank of England. We have that meeting on Thursday. We'll get a sense of what they're suggesting. Market expectations certainly look to be pricing in an interest rate increase, but we know the November meeting was expected. It didn't come. December, we did get the increase. Thanks, Chris, for joining us today. We'll look forward to welcoming you back later, maybe in the week, and we'll also look forward to you, our viewers, joining us tomorrow. Many thanks.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.